Our view is that the fundamentals are quite healthy. That is supported by steady demand and meaningfully below trend supply. And at the same time, REITs are trading at historic discounts relative to equities. And in my experience, REITs have historically outperformed following discounts of this magnitude.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest for this week's episode is Zhang, Portfolio Manager, Global Real Estate at Cohen Steers. G is here to discuss her firm's recent entry into the active exchange-traded fund space, including the Cohen Steers Real Estate Active ETF. G, welcome back to the podcast.
Thanks for having me.
So, to set the context for our listeners, could you start by talking broadly about the development of ETFs, the role they play for investors, and why Cohen Steers chose to enter the ETF market at this time?
We launched 3 active ETFs focused on real estate, preferred securities, and natural resource equities earlier this year. ETFs are a fast-growing market and have become the preferred vehicle for the wealth channel. And it's our belief that launching our active ETFs reinforces our commitment to providing investors with a full range of investment strategies and vehicles that help them achieve their objectives, unlock the potential for excess returns, and build better portfolios. So we believe the time is right for our strategies, and we have high conviction that REITs have repriced for the new environment. And we at Cohen Steers have deep expertise in these asset classes. We're a market leader in actively managed REIT strategies and the largest active REIT manager globally.
And what are some of the advantages of pursuing an active management strategy for listed real estate?
Yeah, that's a great question. Alpha generation, historically, if you look at the data by listed REIT active managers, tend to be more superior than broader equities. And the reason for that is REIT is a relatively specialized sector, and there is wide dispersion across property types because of different economic sensitivity, different lease duration, very localized supply and demand dynamics. And of course, hotels can trade very differently from healthcare and can be very different from data centers. So there's a lot of dispersion and opportunities for us to leverage these different dynamics across 17 REIT subsectors and dozens of geographies to create alpha.
And turning to the Cohen Steers Real Estate Active ETF specifically, can you talk about the strategy you'll pursue and the overall goals of the fund?
Sure. So the ETF is designed specifically to access a broad universe of listed real estate securities. And the idea is to invest in high conviction ideas in US REITs while opportunistically investing in international and other real estate related securities. But the ultimate goal is to provide total return and portfolio diversification.
So, how does Cohen Steers see the macroeconomic backdrop for REITs today?
Sure. So listed REITs obviously has gone through a kind of tough period of transition. But as we look forward, our view is that the fundamentals are quite healthy. That is supported by steady demand and meaningfully below trend supply. And at the same time, REITs are trading at historic discounts relative to equities. And in my experience, REITs have historically outperformed following discounts of this magnitude.
Great. And if you could just maybe go into a little bit more detail about REITs and their valuations at this point.
There's a couple ways we look at REIT valuations. A big part of it is relative to equities. And historically, REITs have traded at a slight premium relative to equities from a multiple standpoint. And today, we're sitting at multiple turns of discount relative to equities. At the same time, relative to private market values, the good thing is that we do think that private market values have bottomed or in the process of bottoming. And relative to private market valuations, REITs are trading relatively in line. On one hand, we do think that REITs have the opportunity to outperform equities, but at the same time, we also think that the public players within the real estate space are gaining the cost of capital to start acquiring assets accretively to generate more value. And they're using their cost of capital to not only acquire assets, but also redeploy and development. And that's another source of growth for the listed REIT market.
Taking that into account, where does Cohen Steers see the greatest potential for REITs and listed real estate today?
So today, one of the sectors we like a lot is healthcare and specifically senior housing. We're entering a period of very strong demographics. Baby boomers are entering age where they're moving to senior housing facilities, and we think that will continue for the next number of years. And that is also coming at a time when supply is very low. No one was building more senior housing facilities during the pandemic, especially not with the higher interest rates and construction costs we have observed. And typically, there's a long time to complete a senior housing facility from start to finish. It typically takes a few years. So, given that starts are very, very depressed and have been depressed for some time, we're not expecting much competition at a time when we might need it the most. So that's where we see really favorable supply and demand dynamic within that sector. And also added to that, we do think that the listed players have a increasing competitive advantage through their scale, through their operational efficiency. They're doing what the apartment companies have done years and years ago in terms of using data and systems to really not only maximize revenue, but also think about operational efficiency and how to increase margins.
And G, are there any other sectors that look particularly promising to you or just of particular interest?
Yeah, single family rental is also quite interesting. A similar demographic story, but this time with millennials that are aging and moving out of urban cores into houses with a yard and a good school district. We're also still very favorable on the technology sectors, whether it's data centers, whether it's towers. Obviously, there's been a lot of noise in the market this year as relates to technology changes, but we firmly believe that the general trend of data usage and needs it's still growing, and therefore the demand on data center capacity continues to be up and to the right. It might not be a straight line, but we generally think that continues to outpace the demand curve for most other sectors.
And other key trends or developments that you're watching right now for their potential impact on REITs and listed real estate?
Look, I would say the risk right now is more on the policy side. And the two in particular that we're watching quite closely, one is tariffs and the other is immigration. With tariffs, I would say there's, of course, just general uncertainty for both corporate decision making, but also for consumers because there's uncertainty in terms of when they go to the grocery store, when they go out, what is it going to cost? And of course, from a tariff standpoint, there's also a direct impact to both the flow of goods and also the cost of goods. And then on immigration, our primary concern there is around labor availability broadly. But at the same time, also to the extent there will be less general population, how is that going to impact the consumption of goods, the consumption of housing? So those are the two risks that we think could be swing factors for the economy that, of course, has implications for various REIT sectors.
G, thank you so much for joining the podcast today.
Thanks, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.